we do have our managing editor, Nikunj Dalmia, especially on this day to understand, what is happening in the markets. He's having a special chat with Nilesh Shah, but let's go across firstly to our managing editor, Nikunj Dalmia.
Well, Nilesh Shah of Kotak AMC joins us now. Nilesh, again, from last couple of months, has been making a case that there were excesses in the market which need to be checked on, and market correction has kicked in. Now, in a bull market, you don't know when the correction would kick in. All you can say is that time and again the bull market evolves and excesses often get flushed out. But the problem in today's digital world is that everything is so compressed that correction will be large, rally will be large, the sell-off will be magnified, and the sentiment sometimes takes turn in less than 10 to 15 days. And Nilesh bhai, good afternoon. Thank you for joining us. From a bit of a excitement and a bull market euphoria around Diwali, looks like we are in for a very subdued winter. So between Diwali and Christmas, the mood has changed completely.
Yes, Nikunj bhai. And as you correctly mentioned, in this digital connected world, the actions happen much, much faster than anticipated. We believe there are a couple of reasons why this correction is ensuing. One, the scare of Omicron. There are conflicting reports in South Africa versus, let's say, Korea, Germany, France, UK. And hence, there is some amount of caution. The second is long China, short India trade recommended by some of the brokerages, as Indian markets outperformed emerging market peers by more than 50%. From 8% weight in MSCI emerging market index, we were at 12%. Obviously, this prompted many people to book profit. Third is also the concern on inflation and change in monetary policy around the world. Bank of England became first developed market central bank to raise interest rates. And all these things coupled with slightly higher valuations resulted into this correction.
Nilesh bhai, why is that bond markets are not panicking? If inflation is so stubborn, then the bond yields or the 10-year paper, which often is used as the biggest benchmark to understand what is coming next, is at 1.45, not at 2.05.
So in the US bond market, probably they are worried about Omicron and they are betting that Fed will not be able to raise interest rates as indicated in their dot chart. Fed has announced 3 rate hikes in calendar year 2022 and about 3 to 4 rate hikes in calendar year 2023. The US market is betting that thanks to Omicron, Fed will be more accommodative than what this dot chart is indicating, and they will raise interest rates probably in much more calibrated manner than what is being talked about. In the Indian context, the case is totally different. Our markets have priced in rate hikes by RBI. Even if repo rate becomes somewhere around 4.75 to 5, the current 5 years at about 575 and current 10 year at 6.5 can be justified. So our markets are discounting potential RBI action, and in US markets are anticipating that Fed will not be as aggressive as indicated.
Where does weakness of rupee fit in? Everything is now moving as per the template. First, dollar started strengthening. Then you saw a mild uptick, which is there in the US economic data that has translated with some emerging market currency weakness as well. Rupee is an important moving factor. How does that change the assumptions and dynamics for 2022?
So I think rupee will be least of worry for global investors. It is destined to depreciate thanks to inflation differential between India and its trading partners. However, the gap has narrowed down from high single digit to now low single digit. And RBI with $640 billion reserves in hand, and India having more foreign exchange reserve than total outstanding foreign exchange debt, is certainly in far better position in emerging market compared to other peers. So rupee will depreciate a little bit. RBI will use FPI outflows to ensure rupee is near its real effective exchange rate, but it will be least of the botheration for global investors. The rupee's depreciating behavior will be in line with investor expectations.
Nilesh bhai, just for the benefit of our viewers, I'm just want to send this message out that for a SIP investor, life does not change. In fact, the SIP investor should be happy because you will be able to buy more units. So I'm going to keep the SIP investor and the long-term investor who's watching the show and say that, look, you don't have to worry. But let's understand the market and what are the turning points now. The FIs have been selling now, whether it is profit booking or whether it is mean reversion. The fact they are selling, I think, is evident. What do you think would be the turning point where the current round of selling finishes and they become net buyers again? What could be the trigger and turning point?
So the one trigger point will be in terms of Omicron behavior. If we continue to avoid third wave with vaccination and COVID appropriate behavior, then certainly markets will become more optimistic. The second thing will be relative valuation of India vis-a-vis its peer group. Today, we were at extremely high valuation difference and extremely high outperformance over peer group. We will correct, they will rise, and hopefully we will meet at a point where FPIs find India attractive vis-a-vis other emerging markets. These two are not in our control, but certainly two other factors which can support market and turnaround is in our control. One is the December quarter result. We believe December quarter results will continue to positive trend in corporate earnings growth. We should be on our way to touch 875 rupees earning per share for Nifty in FY23. And the second thing is budget. If budget is pro-growth and continue and takes forward the reform process, both will support the market. So we need some luck in terms of Omicron and other peers' performance, and we need to deliver on the market expectations on earnings growth and budget.
Luck, hope and prayers. Everybody is doing the same when it comes to the virus spread. In hindsight, if we talk about Diwali 2021, there was a bit of an excitement and euphoria, and those who sold the greed, they are today laughing to the bank. When we will look back at the December 2020 sell-off, it's not a meltdown, it is a correction, not a crash. In hindsight, will this be a good buying opportunity?
Undoubtedly, yes, Nikunj bhai. This correction is a good buying opportunity, but you need to look at your asset allocation. As you mentioned, Nikunj bhai, if you are an SIP investor, please continue your SIP. If you want to do some amount of top-up, today is the time. If you are a long-term investor, then please maintain equal weight allocation to equity. Markets are fairly priced. They are not cheap, so you should not be overweight in this correction, but certainly equal weight, neutral weight in terms of asset allocation to equity. Avoid penny stocks, avoid those stocks where due to low floating stock and concentrated holding, prices are high, valuations are high. These are the two segments where we still believe there is potential for more capital losses. But other than that, rest of the market is fast approaching a buy zone from an equal allocation point of view.
So let's spend some minutes, Nilesh, by trying to understand what is good and what is bad in this market. Broadly, India is a $3 trillion market. That's the size of the market cap. How much of the market, to your mind, is in that over euphoric zone? How much of the market is in hold zone, and how much of the market now after the correction looks attractive?
So Nikunj bhai, I'm giving rough estimate. I believe between 500 and 2,000 majority of stocks will be in red zone there due to concentrated buying limited floating stock. Many a times prices are way ahead of fundamentals. The second is in top 500 companies, there are probably 30 to 40 stocks where valuations are way ahead of their fundamentals thanks to low floating stock and concentrated holding. So if you remove these two segments, majority of below 500 stocks and select stocks in top 500, you still have more than 450 stocks to choose from where management is good, governance is decent, and valuations are fast becoming average or fair.
Have banks corrected enough that we can call them attractive?
Within banks, Nikunj, there will be differentiators. There will be one set of banks which will not be able to own customer. Those customers will be taken away by fintechs or neobanks. And then there will be set of banks which will compete with fintechs and neobanks to own customer. Any bank which is invested in technology sufficiently to own customer will be a winner in this race. And at this point of time, prices are attractive enough to invest into them. The second thing is related to credit growth. If you retain customer, your deposit growth will be better, your cost of deposits will be lower, but still you have to go and deploy that wisely. Banks which have good credit culture, which have diversified credit portfolio will do well. So in this correction, all those banks which are owning customer through technology and which has diversified credit portfolio, they should be added.
And just to wrap it up with one final question, if you look at the recent example, not a recent example, but a couple of years ago when Patanjali hit the market, FMCG stocks went through derating. Patanjali was considered to be a force to reckon with, and it did cause disruption. But today nobody is talking about that disruption in the FMCG sector. Life is back to normal. Could the same factor happen because of fintech? Everybody is bothered about which end of the supply chain of the banks will get targeted. But couple of years from now, it will be history.
Nahin, Nikunj bhai, I beg to differ. I think this is time where only paranoid will survive. The fintechs are not something which is like a monsoon season mushroom. They are here to stay, and they are making a lot of disruption. I personally looked at one neobank's app, which is able to provide so much information to user, which a traditional bank's app or website is unable to provide. Their interface is different. Their user experience is different. And with that kind of interface and user experience, it is fair to assume that these banks are here to stay. They will give tough competition in owning the customer, in providing connect to the customer, and hence banks will have to take them very, very seriously.
Nilesh bhai, you've been very generous with your time, and thank you for joining us on such a short notice. But I guess markets really want to hear from stalwarts like you on a day like this when things are really getting beaten black and blue. Really appreciate your time, and thank you for joining us.